In the last 1 year, the Indian equity market has essentially delivered 0% returns. Yes, you heard that right. Both Indian benchmarks, the Sensex and Nifty, remain flat when compared to 12 months ago. In this edition of Everybody's Business, we'll talk about the why, how, and what next of this story. We'll also look at how the Indian markets compare with other major markets in the world. But first, let's look at some hard data. The Sensex closed at 84,914 points on September 24 last year, and on September 25 this year, it ended at 81,630 points. Nifty, on the other hand, closed at 25,940 on September 24 last year, and on September 25 this year, it settled at 25,033 points. If anything, in both cases, a little lower than last year. And it's not like the markets hit big highs at any point during these 12 months. While Nifty hit a high of 26,277, Sensex hit a high of 85,978 points. If we talk about stats from last week, equity benchmarks extended losses for a fifth straight session on Thursday, which was their longest losing streak in over 6 months. This was the lengthiest decline for the Sensex since March 13 and for Nifty since March 4. And Trump's H-1B visa fee announcement had a role to play. The broader BSE 500, which represents roughly 93% of total market capitalization in India, largely remains flat. And this indicates weakness across large, mid, and small cap segments. Other key data points also confirm the pressure on Indian markets. In early 2025, sell-offs erased over $1 trillion in market value from Indian equities, one of the largest such drops in years. Foreign investors have pulled out about 8,000 crore rupees from Indian equities so far in September, weighed down by global uncertainties such as Trump's tariffs and persistent geopolitical tensions. In August, this number was about 35,000 crore rupees, and the total equity sell-off by FPI so far this year has been 1.38 lakh crore rupees. So, what is the significance of foreign portfolio investors? FPIs are overseas entities such as mutual funds, pension funds, hedge funds, or sovereign wealth funds that invest in a country's stocks, bonds, or other financial assets. FPIs are also important because they provide large pools of capital, add liquidity, and even influence market sentiment. Their buying can lift indices sharply, while sustained selling often drags markets down. Since FPIs account for a sizable share of daily trading volumes, their flows directly impact valuations and volatility. Global investors appear to be rebalancing towards the US and China. Over the past 12 months, India's stock markets have broadly underperformed many global markets. Indices such as S&P 500 have produced double-digit gains, outpacing India's flat performance during the same period. More than 300 of the BSE 500 entities are trading 20% or more below their all-time peaks. And this shows that the strong rally after the COVID pandemic has now completely stalled. Now, there are two ways to read flat growth. One, flat on average through the year, where the index spent long stretches near the same level, and two, flat net return, where intra-year volatility erased gains, so the net change is small. India's markets have seen material swings and then sizable episodic losses. Both Sensex and Nifty were at record highs at one point last year, and current levels are only a few percent below these highs. And this shows that the story is not of a deep crash. It is a loss of the overall momentum. I'd like to pause here for an important note. Experts and analysts say that all long-term investors must stay put in the market. That such flat growth periods can be an opportunity for mutual fund investors to accumulate more units through SIPs. In fact, steady mutual fund flows have cushioned the impact of the FPI selling in the markets. Now, what exactly has caused all this in the last 1 year? The 2-3 previous years saw a boom in the stock markets with new highs. So, what exactly changed? The one-word answer is Trump. But of course, there's more. Persisting trade tensions with the US have had a big impact. And just when things appear to steady a little, Trump deals another blow. The latest H-1B announcement is just one of many such examples. Since Donald Trump's return to office in January 2025, tariffs have become a recurring shock for the Indian markets. While Trump's bluster and repeated tariff threats early in the year had an impact, things became real when Washington imposed a 50% tariff on India over what it said was a result of buying Russian oil. And now, Trump's proposed $100,000 H-1B visa fee has rattled the IT sector. After the raised visa fee, the rupee also dropped to an all-time low earlier this week at 88.62 to the US dollar. The visa news is bad for equity flows, especially into the IT sector. Experts say that the Reserve Bank of India has room to let the rupee weaken, and it is doing so in a measured way. However, the rupee's slide raises import costs, squeezes certain company margins, and increases external financing worries for corporates and banks. And headlines like this also tend to spook foreign investors. At the same time, the earnings momentum also matters. In 2025, corporate profit growth was mostly weaker than people had expected. Some foreign investors have also pointed to slowing demand and consumption. And we'll talk about the government's attempts to boost consumption in just a bit. The recent global market movement has also been largely led by AI related stocks, and India has no big players in this domain yet. Most of these benefits have been seen in the US and China. Put together, heavy foreign outflows, middling earnings, weaker currency, and the Trump factor explain why India's markets ended up flat, while global peers like the S&P 500 and Nikkei posted double-digit gains. Let's do a quick comparison with what the global picture is like. The S&P 500 has moved up about 15% over the last 12 months. Some Asian markets, notably Hong Kong's Hang Seng, have been much stronger. Korea's Kospi has risen 28% and Germany's DAX has surged 23% in 2025. So far in this year, Japan's Nikkei has rallied 16%. China's Shanghai Composite has gained 27% and Brazil's Bovespa has increased 10%. In short, many major markets have grown over the past year. Now, what's important in this whole picture is that consumption needs to pick up to boost the Indian economy. I must add that while demand underpins the very fundamentals of the economy, markets don't always mirror real-time demand. That said, according to Marcellus Investment, in the aftermath of COVID, the government began a massive bout of public capex, which climaxed in FY 2024. As excess hirings made during COVID started unraveling, the demand of employers for labor stagnated and wage growth began falling. In fact, after adjusting for inflation, wages seem to have fallen in India in the post-COVID era, according to Marcellus. And the combination of a higher fiscal load, fewer jobs, and weak wage growth put the Indian consumer in a funk. Now, over the past 6 months, the government and the RBI have taken several steps to boost consumption. The latest union budget said that those earning under 12 lakh rupees per annum will no longer have to pay income tax. The GST tax cuts that kicked in on September 22 amount to a 2 trillion rupees per annum stimulus as per the calculations of Marcellus Investment. It says that SEBI's newly discovered desire to curb speculative trading in the F&O market is also likely to push money back into consumption. And 4 repo rate cuts by the RBI are likely to reduce the Indian households' annual outgo on interest payments by 1.6 trillion rupees. The firm also says that since 2020, Indian households have taken on record levels of debt. The RBI is repeatedly highlighting in its financial stability reviews that a large portion of middle-class households are struggling with their debt burden and will need multiple rounds of tax and rate cuts to keep their heads above the water.